All right, this past Tuesday was the 34th anniversary of what was known as Black Monday, or the stock market crash of 1987. And I remember it vividly. I had just, I'm talking about 2 weeks, established with my partner Martin Saltzman, AFM Investments in Howell. We were 27 years old, him and I. We borrowed money, at least I did, to get the firm started. And it was just a couple of weeks later, not even, that the markets crashed in the 1987 Black Monday. And my partner and I, 27-year-olds with no money, were wondering what the heck we were getting ourselves into, opening up what was an investment firm in the midst of the worst crash since 1929. And it was, as a matter of fact, it was multiples of the 1929 crash as far as percent drop went. So it was October 19th, it was a Monday in 1987. On that day, markets around the world crashed. And the event didn't happen all at once. You know, it happened over a number of days, but the Monday was the big day. The market was dropping prior to the crash. And I'll talk about that in a second. But how much did the market drop on Black Monday? The stock market, the Dow Jones Industrial Average, dropped 22%. Now think about that, 22% in a day. That would be the equivalent of the Dow Jones Industrial Average dropping 8,000 points today. And during that time, it was a pretty hairy time in that, you know, the way markets traded were totally different than they trade today. To do a trade, you actually had to call a market maker. Or if you're dealing with the New York Stock Exchange, you had to call a broker. The broker had to call down to the floor of the exchange. The representative on the floor would go to the booth that traded one specific stock and try to buy or sell there. It was a very antiquated system. So what did all the dealers do? They just wouldn't answer their phones because they didn't want to take any risk. They didn't want to take any transactions. So many people were left without the ability to trade. And there's no worse feeling than that, because I was trying to trade that day too. And when nobody answers the phone and you see markets plummeting and you're losing your shirt, that's what a panic is all about. And make no doubt about it, and the Black Monday of 1987 was a panic. Now let's compare it to the crash in 1929. The worst day in the 1929 crash was down 12%. In other words, barely half the decline of the 1987 crash in 1987. Now, the difference was that the Great Depression followed the crash of 29. In 1987, it was relatively short-lived. In 2 years, the market regained all of its losses and then some. And we didn't go into a terrible recession. We didn't go into a depression. Whereas the 1929 crash, you didn't recover. The Dow did not recover its pre-crash number until 1955, I believe it was. Think about that. 1955. You're talking about what? 26 years it took for you to get even again after the crash in 1929. But it started days before. I remember the Friday before, the Dow was down 5%. And everybody was like, oh my God, that's a major decline. And then down 22% the following Monday as everybody panicked over the weekend. And as soon as the market opened on Friday, it was straight down. But the crash started in Hong Kong. Obviously, the Asian markets opened first. The crash continued all throughout Asia, all the Asian markets during the trading session. And then Europe opened, and the London market crashed as well. Now, what was the cause of the 1987 crash? Nobody tries to figure out, well, what caused it? And I think the consensus really is that the market had gone up so much. The market was up 44% in 1987 alone by September. I remember it. I was working in the summer of 87 when I was planning my new firm. I was working for a firm in Princeton. And I remember driving home every day saying, I can't believe the market goes up every day and hits a new record. And I said, this can't last. Now, I want you to make comparisons to what I'm talking about in 1987 to what's happening now. It's the same thing. The markets have been going up virtually nonstop since the COVID crash. In a poor economy, in an inflationary economy now, with 68 million people losing their jobs, irrationality. So the real reason for the crash is it was a bull market that needed a correction. And it just kept being pushed off. And then finally, a number of factors, the dollar was having problems. There was other issues out there that started to leak the market in September. And there was another thing that played out in the crash of 87. The use of computers enabled brokers to place large orders through the computer system and implement the trades more quickly. So it would usually take time to sell a big block of stock. As I said, you'd have to call down to the floor. The floor broker would get a call, and he'd walk over to the booth that traded IBM, and in the midst of an avalanche of selling, he tried to get a bid. But now you could just do it through the computers in 1987. So the computers were executing stop-loss orders, selling out huge positions, which kept pushing it further and further down. And then there was something called portfolio insurance. With portfolio insurance, it's computerized trading, and it was a relatively new phenomenon at the time. And what that involved was large institutional investors selling stock futures. And when you sell stock futures and the futures go down, there's something called an arbitrage there, where you sell the stocks and buy the futures on the way down, and you make the difference. It's complicated. I don't want to get into it. But portfolio insurance just kept the pace going of selling begets selling, begets selling, begets selling. And nobody wanted to buy in the face of that. Could you blame them? There were concerns about oil prices at the time, interest rates, inflation, trade deficits. What does that sound like? It sounds like now. So those were the reasons that it started to break in September into October. The crash itself was just the finality of it. And that's the way most crashes are. They don't happen in just one day. They start happening days and weeks ahead of time. The market starts losing its momentum. It drops a little bit, then it drops a little bit more. Now people are starting to get concerned. They say, I don't want to give back all my profits, so they start selling. Then all of a sudden, technical levels are broken. And again, selling begets selling. So the Dow recovered 288 points of the 508-point loss. You got to realize the Dow was only 2,200 or something. So 508 points today is nothing. But back then it was 22%. But it recovered 288 points of the 508-point loss in just a few trading sessions afterwards. And the Fed came out. Alan Greenspan was only weeks into the job at the time as Fed chief. He came out and he said he would provide liquidity to the markets, that the Fed would provide liquidity, because there was worried that people wouldn't be able to make margin calls, which would beget more selling and so forth and so on. And as I said, that was the beginning of the moral hazard, I think, where investors thought that the Federal Reserve would always be there to bail out the market if the market started going down. That's kind of the first time that I recall, anyway, that the Fed stepped in and said, we're going to provide you as much money as you need, all the brokerage firms. Nobody's going out of business. Nobody's going to go bankrupt. At least not the banks. And that helped because the market was down. The day after Black Monday, I remember I was driving to have breakfast with one of my large clients who was helping to finance AFM Investments in the beginning. Great guy. I'll never forget him. Has long since passed. But he lent me $10,000 that I needed to get started, in this new business. And I remember driving to his house on October 20th, the day after the crash, and listening to the radio and hearing how the markets were down again big. And then it was about 10:30, I think, that Alan Greenspan came out and said that this is a statement he put out. Now, Alan Greenspan is not long-winded usually, and he's very vague when he says something. But this is what he said the morning of October 20th. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. And it was vague on purpose. But what happened then, miraculously, at 12:38 p.m., a miracle seemed to happen. Stock futures rose out of nowhere, started going up, and started going up big. And it was like lightning. It'd be the equivalent of a 360-point turnaround in the Dow in just minutes. And when people saw that happening, they said, okay, maybe the worst is over, and it's time to go bargain hunting. And now all those computers that were sellers all clicked in to be buyers, because now the market was telling them to buy. And the rest, as they say, is history. The market was saved, and the system was saved. Now, since then, the Fed's intervened in markets many, many times. The 2008 crash, they brought interest rates down to zero, started quantitative easing. The COVID crash last year, same thing, printing money, buying futures. That's the thing. The Fed is an unlimited source of liquidity because of the printing press. They can create money out of thin air, which is a moral hazard in itself, and it's never free because we're all paying for it now in inflation. But they have unlimited amount of money. So through their brokerage firms and the big brokers on Wall Street, mainly JP Morgan is the Fed's broker. So the Fed calls up JP Morgan and says, get in there and buy stock futures, keep buying them until the market gets to this level. And for the Fed account, that's what they do. And they could turn markets around. Is that manipulation? Sure it is. It's absolutely manipulation. They do it in the gold market every day, in the silver market, but they do it for opposite reasons. They want to cap it and suppress it. Then I try to make it go up. But the Fed has the ability to turn around a market and turn panic into greed. When you see a stock that went down, a market that went down 22%, and they see it turn, they're looking at bargains. And when people believe that the Fed's always got the markets back, they buy the dip. And how many dips have been bought? Every time you think this market is over, all of a sudden it rallies again. And we've seen it over the last couple of weeks. Market's down big, big, big. It starts rallying in the afternoon. And then the next day it's up big. No matter what's happening in the world. No matter how bad economic numbers are, no matter how bad the inflation is getting or the unemployment, it doesn't matter. But there's a lot of similarities now I see in markets to that day. And I'm going to tell you, these markets are perilous right now. Regardless of the Fed standing in there, these markets are so overvalued and ripe for a correction at minimum or a crash at worst. I don't think in my 37-year career, and we're going to talk to our guest about this later, because I think he has similar thoughts than I do, have I thought that the markets are this risky, the stock market I'm talking about. And I think many, many people are going to get really, really hurt. And all the gains that they made will disappear in a day. And I'm seeing people coming into me now, they're retiring, and their stock exposure is 87%, 85%. Saw somebody recently, their entire 401k was in the market 100%. How could you do that? How could you have your entire retirement at risk in this stock market just prior to retirement? I shake my head. Now they've done well. I mean, you know, they were on the right side of the bet. That doesn't mean you put all your money on black at the roulette table. Yeah, black comes up. Yeah, well, you did the right thing. No, you did the wrong thing. You got lucky. So now it's pretty hard to have a 22% down day in the market because in the wake of the 87 crash, they created what's called circuit breakers. Circuit breakers stopped trading for a while to give people time to get a clearer head. And I believe their most recent circuit breakers were, at least in 2019, last time I saw them, if the S&P 500 falls by more than 7% from the previous day's closing price, it trips the first circuit breaker, which halts trading in the stock market for 15 minutes. Now, that recently happened during the big crash during COVID. I believe it was March of 2020, right? We were down huge. We were down 3,000 points that day. So the circuit breakers did trigger a number of times. Now, there's a lot of debate on whether or not circuit breakers make any sense. Because all it does is make people panic during the 15 minutes that they can't trade. And many times, as soon as it opens, it goes further down, they trigger the second circuit breaker. Well, the second circuit breaker is triggered if there's a 13% drop from the previous day's close. And the third circuit breaker is triggered by a 20% decline. Trading is halted for the remainder of the day. So the purpose of the circuit breaker system is to try to avoid a market panic where investors just recklessly sell their holdings. And supposedly the circuit breaker is supposed to take people time to make some rational decisions. Also, I think what happens is it gives time for the Federal Reserve to get in there and start buying up futures. So when the trade halt is over, all of a sudden the market starts to rise. But I tell you, there's a lot of similarities. In my opinion, and we're going to talk to our guest later, because our guest claimed to fame was he called for the crash just a few weeks before it happened. And we'll talk about, you know, how he did it and what he's thinking now later in the program between 10:30 and 11 o'clock, last half hour of the program. So markets are treacherous right now. For conservative investors, it's very, very tough to make any rate of return in savings accounts, in bonds or bond funds. It's just like pulling teeth to make money in conservative investments. So a lot of people have been attracted to the market because A, their friends are making tons of money and they feel like they're missing out. And they just need to get some return. And I understand that, but you know, I'm having trouble with some of my retired clients trying to protect them from themselves because, you know, you don't go to the party at 1 a.m. and expect the party to go that much longer. And we're at the end of this move. And I'm surprised that it hasn't been triggered yet. You know, you got inflation. Inflation hurts markets because it hurts corporate earnings. Companies can't pass on to consumers all the increase in prices that they're seeing. They have to eat some of it, which affects their margins, which affects their earnings, which affects their price to earnings ratios. So what's an overvalued market now becomes more overvalued by companies' earnings starting to go down due to inflation. And that may be the straw that breaks the camel's back. Here's an article headline: Persistent inflation poses a real threat to stock prices. And this guy who wrote this article, his name is Michael Leibowitz. And he says here, he gives an example. He says, to understand why, let's buy a pizza shop. As a potential owner, wouldn't you be willing to pay more if you knew workers' wages, rent payments, and the prices of dough, sauce, cheese, and pepperoni will be constant for the next 10 years? Price stability allows for better order management, enabling the owner to manage costs efficiently. As a result, the pizza shop can be more profitable. Equity investors like price stability for the same reason the owner of the pizza shop does. Since the 2008 financial crisis, equity investors have been treated to a healthy dose of price stability. And he goes on to say, as prices go up for materials, then their earnings are going to start to go down. And we're hearing that across the board. Companies are coming out with their third quarter earnings. They're saying all the same thing. Inflation, supply chain issues are going to affect earnings going forward. The Atlanta Fed this week just put out a report predicting third quarter GDP is going to be up 0.5%. The previous estimate was over 4%. So we're very close to contraction in this economy right now. So what does well? I mean, some stocks do well in an inflation. Materials. What are materials? Those are commodities. Energy. Miners. They do well in inflationary environments because their product goes up. And if their cost to get that product doesn't go up that much, it's pure profit for them. What companies tend to do bad in inflation? Well, financial companies, banks, brokers, transportation companies because of energy prices, retail companies, real estate. So inflation matters. And it's not transitory. A Fed governor came out, I think last week or the week before, and stated that he doesn't see this as transitory. This is something that's going to be with us for a while. So crash of 87, crashes are no fun. I've lived through 3 of them. 87, actually 4 of them. 87, 2000, the dot-com bust. 2008, and the crash, the short-term crash in March, the COVID crash, I call it. If you're in the market, I haven't said it in a long time, you got to really consider paring down your risk. Maybe there is another 10% to make in this market, but maybe there isn't. I think the risk of losing substantial amounts of money outweigh the upside potential in the market right now. And like I said, I want to pull my hair out when I see retirees or pre-retired people coming to me with outrageous exposure to the stock market. Like I said, they've had the winning bet, but nobody can see what's ahead of us. And the recipe for disaster is out there right now. All right, let's take a break. 732-505-1160 is the call number. My name is Lou Scatigna. Don't go away.